Hey, it's Amy Lewis from the KFBK Morning News with Brandon Haefele from Catalyst Mortgage, the CEO and founder. And you know what? Bait and switch. Pretty strong words, right? You may not have heard those words before, but you know what? You might have been a victim of it. We know what it means mostly, but do you know how to spot it when it comes to, say, a home loan? We've been talking in recent weeks about how to prepare yourself to navigate a changing market. That's what the Catalyst Report is all about, really kind of breaking things down clearly so we can all understand them. So first of all, Brandon, define bait and switch.
You know, really, Amy, a bait and switch would be something that you're offered from a lender or from anyone in any service field.
Yeah.
In the beginning, that's different at the end. So what they told you up front to the end is completely different.
Okay, so now put it in the mortgage market.
You know, recently, an example that we've seen, people right now are applying for home loans. Interest rates are going up, but
Yeah.
the overall market share is shrinking. And so with that being said, you have the same amount of loan officers that are essentially going for that piece of the pie and that shrinking pie. And so with that being said, we're really starting to see loan officers take the tactic of offering consumers ultra low interest rates with closing costs where they're charging them discount points and so on. And then by the end of the transaction, things are changing. And to break this exact situation down, because it's a complex one, a consumer will apply for a mortgage with ABC lender. That ABC lender is going to go ahead and charge them 1.5 or 2 points discount point to get a lower interest rate. But at the same time, on this on the loan disclosure, the loan estimate, the loan estimate will show a lender credit covering those fees. Well, in the beginning, this consumer is going to say, okay, great, this looks nice. I'm going to have a lender credit from you as a mortgage company to cover my points. Everything looks great. But what we're seeing is by the end it's changing. And some of the tactics that we're seeing that lenders are using are on this initial loan estimate, they are estimating your value much higher than you would estimate your value.
Right.
They are going to change on the very bottom when you're getting cash out, let's say you wanted to do a cash out loan, they're considering your loan rate and term. And why those things are important is because those are the legal ways to trigger a change of circumstance for a lender. Meaning, if a value came in low based off of an original estimate, then the lender has a legal ability to then change the loan terms and say, well, you know what? We estimated your value at $600,000. Even let's say you thought it was $500,000.
Right.
We estimated at $600,000. The loan estimate we gave you and the offer we gave you with this low rate and this discount points and this credit, that offer is now null and void because your value didn't come in at $600,000, it came in at $550,000, so your loan to value changed. Or they'll use the same exact, oh, you wanted cash out? Well, we gave you a loan estimate for rate and term, meaning just doing the refinance of just the actual loan. Well, now since you're going to do cash out, that's also going to change it. What do you
Okay, I'm just going to say this.
No,
No. Well, I like this because what I want you to do now, so now we know this is the deceptive way of doing a loan. So for people who now know the deceptive things to look out for, what is the proper way to do a loan?
Right. Well, it's important. I'm going to touch on the previous topic a little bit more in the sense of when you have a loan estimate from a lender, there should bona fide discount points means you're getting the lowest interest rate, and then you're essentially buying your rate down to that lowest rate. There should usually never be a lender credit. Regulators, just across the board, frown on the idea that a credit can still be given while you're able to buy down your rate. It really doesn't even make sense.
Yeah.
I'm going to be able to, the lender's making this back end profit to be able to credit to cover a discount point. Perfect examples in previous segments we've talked about the teeter-totter. The higher the rate, the lower the fees, the lower the rate, the higher fees. If you're going for the lower rate, how can you still have a credit when usually it's the higher the rate, the more the credit to cover the fees, meaning to make lower fees. So point is there's a play on there. And when we're saying that a redisclosure can happen and a change of circumstance because the value comes in lower or whatever, that's when we'll see a lender credit removed, or we'll see the discount points change, or we'll see the interest rate go up. That's when the lender will make those things.
And when I see that happen, that's a red flag.
It's a huge red flag.
Yeah.
But what we're seeing there is most consumers are so far invested that they, at that point, will just close the loan.
Right.
But to go back to what you just asked is, how do you spot this? Well, when you get a loan estimate, let's say you're in the very beginning of the process and you're getting a loan estimate from a lender, you want to look at things like, are they actually using your credit score? Is the credit score that you're, with all of the disclosure packages that's in there, is your score accurate? Number one. Number two, cash, to the table, or are you getting cash back? Meaning, is it a rate and term refinance, or is it a cash out refinance? Number three, is the value estimated correctly? And the reason I just say those three things, they will tell you if let's say the value is completely off from what you told the loan officer.
Yeah.
Let's say you're not getting cash back when you wanted a cash out loan. These kind of things can really, you want to make sure they're accurate up front. Again, it's part of the lender's responsibility to make sure
Absolutely.
everything isn't the same in the beginning to the end.
Yeah.
But as a consumer, you want to make sure that you're doing your due diligence to say, okay, this is what I told you on my loan application. This is how I applied for the mortgage. Why is this information not correct?
Yeah.
But moreover, if something changes like that, shop around.
Yeah.
Shop that and say what's going on, and especially up front.
Yeah.
Shop around, and if one loan officer and one company, the rate is so much lower and so different than the other companies,
Yeah.
again, if it's too good to be true, it probably is.
Exactly what I was just going to say. That's the whole thing. And the thing about it is, too, if it feels wrong to you, if you're in the middle of the process and it feels wrong to you, or if a red flag has come up, don't ignore it. Honor that red flag. Honor that intuition, right? And maybe if you're with somebody else, call Brandon or call somebody and say, does this make sense to you? Am I a victim of bait and switch? That I truly think is what the Catalyst Report is all about.
Well, and also you can go on the Consumer Finance Protection Bureau website, and it will clearly explain as well different loan terms, and we could put this on a link, on this video of where to go for resources.
Yeah.
And make sure that you have the information, because it'll break it down on. And again, if you're a victim of this type of practice, of course, report it and make sure that you are doing your part to stop another consumer from potentially having that issue.
Yeah. Just be a smarter consumer. Absolutely. Just be somebody who is willing to stop a process if it doesn't feel right, and make sure that you're getting exactly what you went in asking for. That really is what the Catalyst Report is all about. So if you have any questions, you can call Brandon. You can go to the Consumer Finance, say that.
CFPB, Consumer Finance Protection Bureau website.
What he said, or go to the Catalyst Report on Facebook every day.